All right, big news coming out from the Federal Reserve today, and just keeping an eye on the market as well. And we got the not just the Federal Reserve, but the summary of economic projections. So, welcome to the special live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today with interest rates in less than 30 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And as always, I have my favorite channel, Bloomberg, ready to go. And they are talking about this and that and whatever. And good afternoon to Art of War. And this is also being live streamed in my private group. So if you're interested in joining my private group, you can visit firesuch.com/community. And Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And you know how he speaks, right? He's always going to be like, we don't know. Well, the market looks good. The labor market's strong. But kind of want to see what he is going to say about the interest rate decision and what he and the committee are looking to do for the remainder of 2025. So we definitely want to hear what Jerome Powell has to say about today's decision to maintain the interest rates at 4.25 to 4.5%. And again, more importantly, how many rate cuts the Fed is looking to do for the remainder of 2025. Is it going to be 2 rate cuts or is it going to be 3? And if they go with 4 rate cuts, the market is going to start getting nervous, because what does the Fed know that the rest of us don't, right? And to find that out today, we're going to get the latest summary of economic projections, or SEP, so that we can get a better outlook of 2025 about how many times the Fed is looking to cut interest rates throughout the year. And maybe they're going to cut more than twice in 2025, with the recent GDP projection for Q1 showing a contraction. And if you're watching this on replay, I'll be sure to leave chapters in this video so you can navigate your way around the live stream. So anyway, I posted this, and you know what? Let me go ahead and share this real quick. I forgot to present this. Present, share, and share. There we go. Okay, so I posted this in my private group about a few weeks ago. I would say probably about 2.5 weeks ago. I had a very late night thought and said, what if Trump is doing all of this on purpose? And just hear me out, okay? Because if you've been following closely to the stock market, or just the market in general, Jerome Powell already said that he is not in a hurry to cut interest rates. Trump wants to cut interest rates, and Trump and Powell are not exactly the best of friends, ever since Trump said on his campaign trail that he was going to fire Jerome Powell. So what would drive the Fed to cut interest rates? Based on Powell's testimony to Congress and the previous press conferences, they pay attention to inflation, the GDP, and the unemployment rate, and many more, right? We already had a drop in retail sales last month, and the stock market is in the correction territory, which is down by 10% from its 52-week high. When Trump told Fox News that he doesn't pay attention to the stock market, and I know that's not true because he's a businessman. So, of course, he's paying attention to the stock market. He was proud of his stock market performances. I know I'm saying his, but he was proud of the stock market performances during his first term, and he talked about it a lot during his campaign. So I know I'm not the only one thinking about this. So I thought, this is something to think about. And, maybe it's just a way for them to start, thinking about the rate cuts based on what Trump is doing. And this is, obviously one of my conspiracy theories, whatever you want to call it. But I realized that there are many people who actually have the same late night thought when I posted that. So, again, you can join my private community after the live stream if you want to. But anyway, and people who are, kind of complaining, right? So brand new investors, the stocks being down, are probably the people who just recently started investing. And I understand, because I feel like every time I buy something like a stock or something, the price just immediately drops the next day. Like they know when I buy them or something, right? Let me know in the comment section if you feel the same way. And if you're a long-term investor, you have to look at the stock market like it's selling at a 10% discount, not that it's down by 10%. And when the market dropped by 10% at the end of like 2018, I bought more shares. When the market dropped by 20% in 2022, I bought even more shares, because looking back, I wish I had bought more. And let let me ask you this, okay? Would you go back in time to 2008 or 2009 and scoop up those shares when the market was down by 50% or more? You would, right? Because you know how it turned out. Your fear right now is not knowing where the market is going next. And that's why you may be having this hesitation to buy stocks because you're afraid of catching a falling knife. Just something to think about. And the stock market started to drop more significantly when this news came out from the Atlanta Fed about a few weeks ago now. Federal Reserve Bank of Atlanta gave an estimate on March 3rd that the Q1 GDP is projected to drop to a 2.8% contraction due to tariffs. And the updated GDP Now forecast shows a 1.8% contraction for Q1 2025, which is still the biggest decline since the Great Recession in 2009. But we actually won't get the advanced GDP estimate for Q1 until April 30th. So that's going to be the first GDP release that will include President Trump's time in office. But the market began to price in the slowing GDP when they saw the projection. And it may come out better than expected, or it may come out worse than expected. And we won't know that until we get the advanced estimate on April 30th. And both Trump and Elon Musk have been advocating to exclude government spending and government employees from the GDP and the labor data. And they made it pretty clear that they want to shrink the government sector to grow the private sector. But the private sector isn't exactly having the best forecast for 2025. And Goldman Sachs just cut the S&P 500 year-end price target from 6,500 to 6,200. RBC Capital just cut the S&P 500 year-end price target from 6,600 to 6,200. And the Yardeni research also dropped this target to 6,400. Headline retail sales fell 0.9% in January. That's a contraction. And the retail sales data from Monday showed a very small increase of 0.2% for the month of February, which was far below the expectation of a 0.6% increase. The airline sector right now is seeing a significant slowdown in demand due to slowing spending. You probably heard about the Southwest Airlines, right? They're going to start charging baggage fees. And I've been flying Southwest my whole life. And I understand it's disappointing, but when you look at their earnings and they just keep bleeding money on that, they just had to find, I'm not trying to defend Southwest here, but they just had to find some way to increase their revenue. So anyway, does this mean that we're going to go into a bear market like we did in 2022? Not always, because let me show you this, okay? Market corrections are usually short-term, and they happen on average once per year and lasting about 2 to 3 months. And according to the Yardeni research, the S&P 500 has logged 56 market corrections since 1929, but only 22 of them became a bear market, which means that it went further down from 10% to 20% or more. And the problem with these market benchmarks like the NASDAQ and the S&P 500 is that the Magnificent Seven stocks like Tesla, Nvidia, Meta, Google, Amazon, Apple, and Microsoft are significantly carrying the indexes. So when these stocks go down, you can bet your butt that the S&P 500 will also go down. So historically speaking, there is a 25% chance that the current market correction will go into the bear market territory, but the other 75% did not turn into a bear market. And if you look at the 2020 COVID crash, it went straight down, right? And then it started to recover. And the S&P 500 ended up finishing with around something like 14% in a positive return. But if you look at the dot-com bubble from 2000 to 2002, that was a 45% drop for 25 months. And that would absolutely suck for retail investors like you and me if we see a bear market for that long. And to me, the recent market correction is something I'm used to. A correction means that the S&P 500 from its 52-week high at 6,150 is down by 10% to 5,535. And when it drops below 4,920, then it's defined as a bear market because it's down by 20% from 6,150. You can look at it and look at every market index to see which one is in the correction territory. And if you look at Russell 2000, it's down about 17% from its 52-week high. So you could probably argue that it is pretty close to the bear market territory. And NASDAQ is down by about 11 or 12% right now. So you can say that it's in the correction. That makes sense so far, right? And a stock market drop by 3% or 4% in a day is not a crash. And if you want to see a real crash in one day, you got to look at the great crash of 1929 when the market dropped by 13% for several days in a row. And the Black Friday in 1987 saw the market drop by 23% in a single day. And the market crash in March 2020 saw the stocks crash by 13% in a single day. And that's a crash. Am I going to buy more if the market continues to drop? Absolutely. Am I going to buy more if the market recovers? Yes, but with the amount that's already scheduled to be invested. So my strategy is really simple. When the market is down by 2% or more in a single day, I buy more than what I have already scheduled to buy. And when the market is up, I just keep the contributions the way they are. And I already have a little more cash on the sidelines so that I can deploy it to the stock market when we go through a correction like we are right now, or when we go through a bear market. And whether or not we go through a bear market in 2025, it's going to happen one day, right? It happens about, like twice every decade. And we already had one in 2022. Okay. Now, for today's interest rates, going to the CME watch group here, let me scroll down. There we go. All right. So the CME group is predicting the Fed today to remain or maintain its interest rates at 4.25 to 4.5%. There's a 99% chance. So why am I even doing this live stream right now? Because I want to see what Jerome Powell has to say about the tariffs and how the Fed committee will act moving forward if the GDP does come out with a 1.8% contraction for Q1 2025. The summary of economic projection that comes out today will also give us a better idea of what the Federal Reserve is thinking about the future GDP, unemployment, PC inflation, and many more. Don't be surprised, though, if the Fed decides to cut rates more than two times in 2025. And the next Fed meeting on May 7th, come on, there we go. It shows a 83.9%, we'll just call it 84% chance that the Fed will keep the rates as is. But I think this is going to be a lot lower if the GDP drops and unemployment rises. Remember that the next GDP for Q1 is going to come out on April 30th, and this is way after that. And the market is betting on the Fed to start cutting interest rates on June 18th to 4% it's 4 to 4.25%. And by the end of the year, it could be at 3.5 to 3.75% or 3.75 to 4%. And this is also going to depend on the unemployment data, JOLTS, CPI, PC inflation, and GDPs throughout the year, right? If the economy weakens by let's say the middle of 2025, and we're going to get another SEP in June, I wouldn't be surprised if the rates drop to as low as 3%. And I pay attention to just about everything for a reason. And besides, I'm a nerd, and I want to take advantage of the market downturns as much as I can, because I'm going to be buying these stocks at a discount. People who want to sell out, I'd be glad to take those shares from them. Okay. Now, here are the things that you want to pay attention to between today until the next Federal Reserve meeting on May 7th. So the third estimate of the Q4 2024 GDP is going to come out on March 27th. And this is after they already released the second estimate at a positive rate of 2.3%. I don't think this is going to change much, and it's probably going to go to 2.4 or maybe 2.2% after the adjustments. And this is the one that everyone wants to pay attention to. And I've been saying this in almost every Federal Reserve live stream. The Q1 2025 GDP is going to come out on April 30th. And I wonder if BEA is going to listen to Trump or Elon Musk to exclude the government spending from the GDP going forward. And I doubt it, but we'll see what happens. And I think the date, this date is going to drive the market really down or it's going to go up significantly. The market is pricing in at a 1.8% contraction for the Q1 GDP. Contraction means negative 1.8%, right? And if it comes out better than expected, let's say at 1% contraction or at a positive rate, then don't be surprised if the market moves upwards significantly. And if it comes out about the same at a, let's say, 1.8% contraction or worse, excuse me, then I would expect the market to sell off pretty quickly. And this is just my prediction. And I don't think the market right now is pricing in for a recession just yet. And the next one is the PCE inflation on March 28th and April 30th for the February and March data. And the Federal Reserve pays very close attention to this. And he's been saying this over and over again, is that their price target is, their inflation target is 2%. And we're going to get some more info at 11 a.m. PST, Pacific Standard Time, or 2 p.m. EST when they come out with the latest summary of economic projection. And if it starts to show some weaknesses due to a reduced consumer spending, then I wouldn't be surprised if the Fed starts to cut interest rates much sooner than June. And the unemployment data will come out 2 more times on April 4th and May 2nd before the next Federal Reserve meeting. And right now, the unemployment rate is at 4.1%. But if it starts to creep up to, let's say, 4.3, 4.5 or percent or higher, then the Fed might need to start, to do something to cut interest rates right away. And remember, even just that 0.1% is a significant move based on our population and the labor force participation. And we're also going to get JOLTS on April 1st and April 29th. And if you're just now tuning in, JOLTS stands for the Job Openings and Labor Turnover Survey, which helps gauge labor demand, while the unemployment rate on the other side measures the supply side of the labor market. And the JOLTS report will give us a better indicator of a solid or weak labor market. And we're also going to get the next inflation data for CPI, or Consumer Price Index, on the consumer side on April 10th, and PPI, or Producer Price Index, on April 11th. And don't be surprised if the interest rates start to go down before the June meeting if the banks are pricing in more rate cuts than expected. And the retail sales report will come out on April 16th. And that's going to be interesting because we already saw the weaknesses in January with a contraction. And we got the weak data on Monday for February with a 0.2% increase. And this is the SCP from December FOMC meeting. In about 10 minutes, we're going to get the latest version of the SCP so that we have a better idea of how many times the Fed is looking to cut interest rates in 2025. And we get this report 4 times a year in December, March, June, and September. And this is what I want to pay attention to. This is the range for the Federal Reserve, federal funds rates throughout 2025. So from the December report, they're predicting 50 basis point rate cuts from 4.5 to 4% when I just round that up. And so by the end of 2025, you're looking at the Fed funds rates of 3.75% to 4%. And there are 6 Federal Reserve meetings remaining in 2025 after today. And with the next one on May 7th, when a new SCP comes out today and lowers the Fed funds rates to something like 3.4 or 3.5%, then we're going to see a total of 3 rate cuts, because that's going to put the Fed funds rate at 3.5 to 3.75%. That makes sense so far, right? So that's going to be 3 out of 6 meetings they'll cut interest rates. And if they lower that, let's say further to 3.1 or 3.2%, then you're going to look at 4 rate cuts in 2025. And that could trigger some volatility in the stock market, because Wall Street is going to be nervous about what Jerome Powell knows that they don't. And I don't think they're going to show 4 rate cuts, but we'll see about that in about 10 minutes. And this is the unemployment projection and the changes in real GDP, as you can see at the bottom from the September SCP. It predicted a 4.4% in 2025, but the December report shows a 4.3%. And the unemployment rate that came out recently is sitting at 4.1%. And we're not going to know the unemployment rate for February until the report comes out on April 4th. And if it continues to increase, the Federal Reserve will look to cut rates even more aggressively, in my prediction, throughout 2025. And the 2025 GDP projection is sitting at 2.1% from the December, right here, if you take a look at it, from the December SCP. But don't be surprised if they lower that projection to something like 1.7 or maybe 1.8%. And can the median Fed funds rate get below the previous projection at 3.9%? It's hard to tell at this time, but I wouldn't be surprised if it's lower to something like 3.5% if the range changes from 3.1 to 4.4% to 2.5 to 3.5%. And I want you to keep in mind that the data will almost always change every time the S&P comes out. And remember, those projections are based on how each member of the Federal Reserve feels about the future of our economy. And they can easily change their minds if the future data or the lagging data comes in much stronger or weaker than expected. And these dots I'm about to show you here came from the December SCP that reflects what each U.S. central banker thinks will be the appropriate midpoint of the Fed funds rate by the end of every calendar year. So the new one will show the 2025, 2026, 2027, and 2028 projections, okay? And we're going to get this in, again, March, June, September, and December, or 4 times every year. Now, the dot plots, they come with 19 individual projections, and they're all kept anonymous. So no one knows which official or governor is which dot. And the dot plot was created back in 2012 when the economy was still recovering from the Great Recession to show a form of guidance for the Federal Reserve. You also don't want to look at the 2026 dot plots too seriously because they will change every quarter depending on the economic data that we receive in between these quarters. Anyway, and the last dot plots from December show that a majority of the federal officials right here, okay, were looking to maintain the Fed funds rates between 3.5 and 4% by the end of 2025. So when the new one comes out, I'm going to put it right next to this chart to make the comparison. And I'm going to guess that most Fed officials will move their dot plots to, probably where that green box is. I'm guessing like down here between 3.5 and 4%. The majority of them. And that's probably going to show a possible rate cuts for at least 3 out of 6 meetings they'll have in 2025. Remember, they still have 6 meetings remaining in 2025. So if they go from 4.25 to 4.5% to 3.5 to 3.75%, and that's going to be 3 rate cuts for 25 basis points for the next 6 meetings they'll have. And it probably makes sense for the Fed to pause the rate cuts today and maybe even the next meeting. But it's really going to depend on several data points like unemployment, jolts, PC inflation, and the GDP, right? And I do want to talk a little bit about the tariffs here. Where was it? Did I save that here? Yeah. So the tariffs and the U.S. trade war probably going to be the one of the complete focus today at the press conference at 11:30 a.m. PST or 2:30 p.m. Eastern Standard Time. And Trump has already threatened to impose 200% tariffs on alcohol imports from the European Union. If the prices for goods go up, then the central bank might need to revisit whether the current interest rates are sustainable, right? And there's like a little article here and there saying that Jerome Powell might be looking at, raise the interest rates. I don't think that's going to happen. I know tariffs are, they are an inflationary indicator, and the stock market is factoring in about a 70% chance that the Fed will cut interest rates 3 times in 2025. So what Jerome Powell says at the press conference will matter a lot for the stock market because people are going to overanalyze what he's going to say and what he's not going to say, right? So what if the Fed governors are looking at a higher core PC throughout 2025 on the SCP? Does this mean they're going to raise interest rates back to 4.5 to 4.75? No, don't think that. I personally don't think they're going to raise interest rates because they know that's going to lead to a recession, and nobody really wants that recession, right? And I'm sure how much time do I have left? Got about 4 minutes. So I'm sure the reporters, they're also going to ask about Jerome Powell about the labor market as well. The Bureau of Labor Statistics show that there were 7.7 million jobs open at the end of January. So, which was an increase from 7.6 million we saw in December. And I'm sorry, not December, from January. And that, wait, no, it is December. And that is up by 232,000 jobs month over month. And that's a ratio of job openings to available workers around 1.1 to 1. And just don't be surprised if we, end up getting more revisions in the future jolts. And if you look at where all the jobs went in February 2025, right here, and most of them went to healthcare, right? So 63,000 jobs went to the healthcare sector. But 63,000 jobs are part of the 73,000 jobs added in private education and health services lumped together in the same category for some reason. Financial activities and construction sectors grew at the second highest numbers with a total of 41,000 jobs. And the biggest decline was in the government sector jobs, which is not surprising, right? The federal government jobs declined by about 10,000, but there was a total increase of 11,000 positions in the total government sector because they account for the local government jobs and the state government jobs. So with DOGE, or the Department of Government Efficiency, laying off tens of thousands of federal jobs, don't be surprised if this number significantly declines further in the next jobs report. But now that not the Supreme Court, but federal judges are saying that the job cuts could be unconstitutional or illegal firing. So I'm seeing a lot of posts saying that people are being reinstated back to their jobs, but they're placed on administrative leave. So what that means is that people are coming back to work. No, I'm sorry, they're not coming back to work, but they're on the payrolls, right? So they're on leave getting paid. They're not fired, but they're probably just going to be laid off later on after this fiscal year is what I'm guessing. And lastly, the leisure and hospitality had the biggest decline, and that's not surprising for February right here. And it's almost always the slowest month in the retail and hospitality industries. During the holiday season, these sectors grew by like 53,000 jobs in the month of November, but the slowdown in January and February will likely eliminate those temp jobs, right? And if you take a look at, you can always take a look at the federal government jobs being cut, and I'll review that in a second. But I do want to tune into Bloomberg real quick, because it's almost time.
Are under allocated to public fixed income.
Seen a massive sentiment shift to Europe and other parts of the bond market, haven't we, in the past year or so? This one's a big one. This really is a big decision. This is a tough decision, not because they're going to move 25, 50 basis points. It's not about that this time around. It's about how you navigate these policy changes, this effort to push a global realignment driven out of Washington, D.C. You've got to try and gauge the response of other actors, China, Europe. You've got to understand what it means for markets, consumer expectations, how that's going to translate into things like inflation, growth over the next several months, and somehow put out projections for the world to interrogate.
Which people will have to understand is something of a dartboard throwing darts at it. Some of the questions, and I wrote down a whole host of them that I have for Fed Chair Jay Powell today. One of them is, are you more worried about stagflation-like conditions today than you were on January 29th? And if so, why? What has changed? And see how that gets navigated.
Should be coming out now.
Quickly here, John. The dual mandate, it's all about labor, and it's moving the second derivative of some of those theories. Bernanke would say there's a lot of hockey sticks out there.
And is there a stagflationary mix in these forecasts? Remember,
no changes to the
this
interest.
is a three-part act. In about 10 seconds' time, you get
it's already
two
out.
parts.
No
You
changes.
get a decision and the forecast.
Pull up
30
the
minutes
economic
later,
projections here.
you'll have a news conference with Chairman Powell. The equity market going into this one firmer by 0.4% on the S&P 500. With the decision, here's Mike McKee.
Well, I was wrong. We do have some news today.
Ooh.
No change in rates, but a significant cut in the Fed's view of growth over the next 2 years.
Yeah.
The majority of the committee moving lower on the dot plot, even though there's still 2 cuts forecast for next year.
Still 2 rate
There's
cuts.
a pause in QT and a dissent on that. The benchmark rate stays the same, 4.25% to 4.5%, but the policymakers cut their median GDP forecast for this year to 1.7%.
I nailed it. 1.8.
And next year to 1.8% from 2%. Headline PCE inflation rises to 2.7% this year from 2.5%, and core to 2.8% from 2.5%. The unemployment median for this year is now 4.4%, up 1/10. In their statement, officials removed language that risks to the employment and inflation mandates are roughly in balance, now saying the committee is attentive to the risks on both sides of its dual mandate. They emphasize that by saying uncertainty around the economic outlook has increased. That's reflected in the dot plot. 8 members now see 1 cut or 2 cuts or fewer. The median stays at 2 cuts with 2 more for 2026. The Fed, beginning in April, will slow its balance sheet runoff to $5 billion a month from $25 billion for treasuries. It will retain the $35 billion cap on mortgage redemptions. They don't attribute the change to anything, not to the debt ceiling, but we would expect Chair Powell to talk about that in his news conference. But the change in the runoff drew a dissent from Governor Chris Waller, who approved of the no change in policy rates, but dissented on the idea of slowing the balance sheet runoff.
Mike McKee, there's so much to work through here. Appreciate your time, sir. Apparently, stagflation is bullish. We'll get to that in a moment. We are firmer in the stock market by 0.6% on the S&P. On the Nasdaq, we're up by 0.8%.
Everybody's going to start talking about stagflation.
And the revisions. Let's do that again, because these are significant changes. Let's focus on 2025 and look at the median projection. The change in real GDP, the projection now 1.7%, down from 2.1% previously. Those forecasts made.
You know what? I nailed it. And I literally said it's going to change to 1.8% GDP. And it came out 1.8% GDP projection.
The previous projection, 2.5. And the median dot, unchanged. So, Lisa, what we've got here is the Federal Reserve essentially saying inflation is going to be higher than we thought it would be. Growth is going to be weaker than we thought it would be. And as for policy, well, policy doesn't change. That is the stagflationary mix in the forecast that some people were anticipating.
Because we've heard it from all across Wall Street. If they hadn't done this, that would be sort of surprising, since they seem to be reflecting a general sentiment out there. Key question. How are they going to explain why? What has changed? Given the fact that, yes, we've gotten data that has come down, but we haven't necessarily seen a big spike up in inflation. And depending on what inflation expectations you've seen, you haven't necessarily seen them go up that much either. I do think it's interesting about quantitative tightening. I do think it's interesting about Fed Waller dissenting. And I'd like to hear a whole lot more. I also think it's interesting you're not seeing a huge reaction from the 10-year yield on that.
He's running. Talked about that a few times. We'll come back to that later. If you don't know what we're talking about, Jim Bianco has thoughts. I'm sure he joins us in just a second. Let's turn to the bond market. Bond yields were higher going into this decision. They are now just about unchanged, around 430. So we haven't broken out that range, that very tight trading range over the past few weeks on a 10-year maturity. The 2-year at 4.03%. There's a lot of conflicting stories, a lot of cross currents to this decision here, Lisa. You've got stagflationary mix in the forecast. The median dot remains the same, implies 2 cuts for 2025. And then you're slowing down the balance sheet runoff at the same time. This is going to be a really tough news conference to navigate for Chairman Powell. With those forecasts, it gets harder.
Especially because he's not giving any explanation as to why they are pausing quantitative tightening. He has to explain why they are changing their forecast and why they haven't changed how many times they expect to cut rates. How do they balance these two risks at a time where, again, stagflationary-like scenarios are the worst case scenario for a central bank?
Buried in the headlines is a single one. FOMC median this year unemployment projection rises to 4.4%. The moment that overshoots, the dialogue changes. I don't know, with all of our esteemed guests, John, I'll let you decide. Is 4.5 a trigger point? Is 4.7? To me, it's a round number, 5%. But I'm sorry, 4.4% is emotionally for President Trump a long way from where we are right now.
Tom, I think we have to be really patient about how we process and internalize what the Federal Reserve is telling us this afternoon. I often say when we get a Fed decision or economic data, these are the market moves, let's see if they stick. These are the market moves. We'll see if they stick. I don't think the market moves right now should shape the narrative too much. Just take a step back. Don't even look at the market. The Federal Reserve is telling you that they've had to dial back growth expectations, but that won't lead to lower interest rates. The Federal Reserve is telling you that on the margin, unemployment is going to be a little bit higher. But relative to what we thought back in December, that doesn't mean additional interest rate cuts. On the surface, looking at that alone, and I know there's a lot more going on here, that's a hawkish decision from the Federal Reserve.
On the margins, this is them saying that they need to prioritize inflation just as much as unemployment rising to 4.4%. And that right now, the market's grappling with at a time where inflation is as much of a risk to asset prices as is potentially downward growth.
I'm looking, John, a message just in from Drew Mattis of MetLife. He's getting closer to being a net buyer of treasuries again. I told him to call Bob Michael.
Bob Michael's with us now from JP Morgan Asset Management. Bob, we gave you some time to go over this one. What are your thoughts?
This is a dovish Fed. When I look at how they changed their expectations, they lowered GDP by more than they raised inflation. That's tip number one. You look at unemployment, they're worried about how businesses will respond. So they raised unemployment. That's tip number two. And then they said, I believe, uncertainty around economic activity increases. Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
Put your interest rates where your mouth is, not you, Chairman Powell. Why have they kept the median dot unchanged? What's that about? If they are that dovish, if you're downgrading growth, shouldn't you back that up with a lower median dot?
Well, I think that they're comfortable with the 2 dots where they are. It's 2 more rate cuts. I'll take it.
Jim Bianco of Bianco Research can get in on the conversation. Jim, I'd love your thoughts on this situation. We talked about it, lots of cross current.
Okay, great. I'm going to show you what they're talking about here. So I put the 2 dot plots together side by side. And this is what the Fed is thinking about right now. And so the one on the left, let me see if I can expand that. There we go. So the one on the left right here, this is the from the December 2024 SCP. So as you can see, this is from 4% to 4.5. And there were 4 individuals voted between 4 and 4.5%. But now it's double that to 8 individuals to maintain the Fed funds rate at 4 to 4.5%. I can already see that Trump is going to tweet or say something on Truth Social about this. But this is going to be, but still the vast majority of them are staying between 3.75 to 4%. So if they're going to cut rates twice, right, then we're looking at between 3.75 to 4% by the end of the year. And that would be the December FOMC meeting. But they could do it at any time throughout the year, right? They could cut rates in June, and then they could cut rates again in August. And then they say, all right, we're done for the year and see how that goes. Or, you know, what if the market continues to weaken throughout the year? And I'm not talking about just the stock market, but I'm talking about unemployment. What the guy just said on Bloomberg, if the unemployment rate goes from right now at 4.1%, and then let's say it creeps up to 4.3% by June, and it goes to 4.5% by, let's say, September. Does this mean that the Fed needs to pause and say, okay, maybe we're not doing enough and we need to cut more rates? You know, this is one of those things that they're going to be like, man, I don't know if we're doing this the right way, right? Jerome Powell is not going to say anything fancy at the press conference, because imagine this, right? What if Jerome Powell comes out to the press conference and say, yeah, the world is going to poop and we might have a recession by the end of the year? That's going to drive the market nuts, right? People are going to start selling out. And it's like, whoa, Jerome Powell just said that we're going to have a recession. Of course, he's not going to say there's going to be, the labor market is going to be bad, or inflation is going to be worse, and there's going to be stagflation for 2025 and maybe 2026. He's not going to say all that. He's probably not going to say much at the press conference. But this does give us a better idea of what they're all thinking about. Is they want to maintain the 2 rate cuts for 2025, and because of probably tariffs, and they're seeing that inflation is still going up right now, creeping up to about 3.1, 3.2%. And what's interesting is that they're projecting the PC inflation to go up to 2.2%. And I want to know what they're going to say about this, and I'm sure somebody in the press during the press conference is going to address that. So this is the latest edition. Okay, I'm going to zoom in here so you don't have to. So right here, do you see? Let me see if I can edit this. Can I edit it? Nope. You know what? Let me go ahead and switch over to the Adobe here. So there you go. Press that. Import. I want to highlight so that you guys can see this. Okay. Okay. There we go. Nope, didn't work. Done. Let me see if I can zoom in. I thought I could. Can I draw? Come on. Let me draw. What the heck? All right, here we go. So I'm going to draw here. And let me see if I can zoom in. There we go. I got to do it. All right. So the one that I was going over during the earlier in this live stream. So in December projection, right, you're going to see it at the bottom of the S&P. Every single one of them is going to say from December and what changed. Okay. So that's all the December projection. And the one above it is all the new projection. So 2025, the real GDP, 2.1%, was the December projection. Now it's down to 1.7%. Okay. I thought I could draw this. There we go. So now it's down to 1.7% here. Okay. Now, unemployment is going from 4.3%. Now it's going up to 4.4%. And PC inflation previously was 2.5%. Now it's going up to 2.7%. And the core PCE is also going up to 2.8%. Okay. So what that tells me that the Fed is looking like they want to maintain the interest rates high. So going into 2025, they want to reduce the PC inflation rate. That this is their goal, to going from 2.1 to 2.7 to 2.2%, and then core PCE going from 2.8 to 2.2. And they think there's going to be some toughness going into 2025 at 1.7%. So that's what it kind of shows me right now. And this is where they were looking at 3.9% for the Fed funds rate. So no changes. They want to keep the interest rates as they are and maintaining the Fed funds rate between 3.9 to 4.4%. So no changes really at all. But unemployment here showing 4.4%. So the question is, if it goes up to 4.5% by September, does this mean that they're going to start cutting rates to maybe 3 to 3.25%? And that would be about an additional rate cut or maybe 2 rate cuts to 4, right? They don't always cut the rates by 25 basis points. It doesn't work that way. I mean, they cut the rates by 50 basis points back in September of 2024. So they could look at the data and say, whoa, we got some serious weaknesses in the market right now. And unemployment went up to 4.5%. GDP is contracted. Let's say we're in a recession from Q1 to Q2 2025. Then they could say, all right, we need to cut interest rates by 50 basis points. If you look back at 2008, 2009, they didn't really aggressively start cutting interest rates until the end of towards the middle of 2009. At the end of 2008 was when they started to cut interest rates by 25 and then went to 50 basis points. So you can always take a look at how history was back then. And maybe that was one of the reasons why they had a recession, because the Fed did not act soon enough. And could be one of those things that politically driven and say, well, he didn't act soon enough, so now we're in a recession. Trump, the Trump administration or whoever could easily blame the Federal Reserve and say they didn't act soon enough, therefore we're in a recession. It becomes a political game at the end of the day. But what we want to pay attention to is not just this that I'm showing you right now, but you want to pay attention to the unemployment data that comes out every month. You want to pay attention to what's going on with the PC inflation, the GDP when it first comes out on April 30th. Then we'll have a better look, a better idea of what's going to happen this quarter and then the next quarter, right? So there's a lot of stuff going on, and excuse me, you're going to hear a lot on the news, but what you want to look at is the data, right? When you start freaking out just by listening to the news and say, oh, the news said this and news said that, Trump said this, Congress said that, and Fed said this, you're not going to become a successful investor. I can tell you that. If you don't read or if you don't pay attention to the data, right? I told my private community about a month ago, I said, hey, there's some weaknesses coming up in the labor data, and I'm seeing some weaknesses in the retail sales. Just keep an eye out because your portfolio might start going into the red. And I was right. And I'm not trying to pat myself on the back and say, oh, yes, I was right about all this. So, he's the, Messiah or whatever. I'm not trying to do that. Oh, what I'm trying to encourage you guys to do is maybe tune out some of the news that you hear all the time, right? It doesn't matter what news network. And I know most of them are biased, but just read the data and it's all in there. And that's something that I saw back in January and said, I told everyone in my private group, there are going to be some weaknesses coming up. So to me, it's not surprising. That's why I said in the earlier live stream, I said, well, don't be surprised if we get like a 1.7 or 1.8% for the GDP on the S&P, and I was right.
We are seeing some slowdown. I spend a lot of time talking to a lot of small businesses in the area as well. And one of the things we're really starting to see is things like that.
And just real quick, I really like Bloomberg because Bloomberg has a lot of analysis that is more unbiased than other news networks. So that's why I always choose to use Bloomberg every time I go live stream about the Federal Reserve. So but anyway, just take a listen.
Those are things that are important because that's sort of reflective of some of the consumer confidence numbers. Now, we've also seen a lot of front running of tariffs, and every company I know out there is trying to hedge their tariff situation. That's already pushed up costs of many things even before the tariffs that we have currently went into effect, and they're now having to deal with that as well. And that's a very challenging environment. There is a real chill, of course, in terms of what is the carve out for USMCA, and many companies that technically qualify for USMCA and the carve out that they hope to get in the auto industry on April 2nd, they did not apply for the permission on that because there just wasn't a reason to before, and now they have to be certified. So this scramble in terms of, I'll tell you, our tax and customs group, and I'm working with them constantly, and logistics are absolutely slammed right now.
Diane, there was a time when Tom and me got in trouble for calling an ECB news conference a snooze fest. We're not going to get in trouble this time around because this won't be a snooze fest. This is gripping stuff, Diane. I just wonder from your perspective what you would ask Chairman Powell as that news conference begins in 10, 11 minutes time.
I think the most important thing to ask, because he's not going to be able to tell you what the actual reaction function is, but we know they're doing scenarios. He talks about scenarios. We need to sort of push him on what are the scenarios that the Fed's looking at right now, and what does that mean for policy?
John, Ian Lingan, publishing at Bank of Montreal, BMO, he supports John Farrow's view. The distribution of projections shifted hawkishly.
Look, the fact we're having a debate about it means that Chairman Powell needs to address something in about 10 minutes' time. Dan Swank says it's hawkish of KPMG. Dan, appreciate your time as always. Bob Michael of JP Morgan Asset Management says it's dovish. Now, maybe we can explain this by saying that there are different seats here. One is an economist, just talking about things as they see them. Another is a market participant saying, well, this is what was priced and this is what was expected in financial markets. And maybe you can make that argument this afternoon. But I do think if you take the market out of it, Lisa, if I just looked at those forecasts, if you told me they'd be downgrading growth expectations and maintaining interest rates, in fact, implying that maybe it'll be 2 cuts or less less, not 2 cuts or more, based on where the median dot and the distribution of dots was last time around, I think we'd all agree that that was a touch hawkish.
I think the vocabulary has changed. And frankly, this scenario is gotten away from the vocabulary that we used to use in a very different time. If you're talking about stagflationary-like environments, suddenly the definition of hawkish and dovish takes on a very different approach.
The rules have changed. Matt Lazzetti joins us now of Deutsche Bank. Matt, welcome to the program. We've got a split decision here. You're going to be the breaking vote. Matt, where do you go? Is this dovish or hawkish this afternoon? What is this?
Jerome Powell is going to speak in about 8 minutes. So I'm going to be tuning in and listening to what he's going to say as well. So in about 8 minutes, Jerome Powell will come on and speak about their decision today and moving forward.
Is telling you that they are cutting rates and median expectation 2 times this year, with core PC inflation that's 80 basis points above their target and growth that's essentially around potential, kind of continues to signal that there's a dovish bias there. So I think there's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of 1 rate cut for today, and so far at least that fear was alleviated.
Matt, you expected them to pause their quantitative tightening, this idea of allowing their balance sheet to shrink. Does this actually mean anything other than just a technical adjustment to smooth the gears of Wall Street?
No, I think for the Fed, this is clearly a technical decision. They slowed rather than paused. But again, I think that was kind of a technical decision about how they were going to deal with MBS and the fact that they might have to buy in the secondary market. And so really, this is just the Fed telling the market they're going to be very cautious in dealing with the balance sheet. They don't want to repeat the mistakes of September 2019. And they're going to be just cautious in dealing with how things evolve here.
I'm going to go to strategist John Farrow on this. You can't make this up. Out on Twitter, Ed, thank you so much for this for John Farrow. My 16-year-old son has saved $500 and wants to invest it. Should he wait till after the press conference?
Okay, that's dumb. All right, so I know there were questions about the federal government cutting their jobs, and right now they're looking at cutting 250,000 federal jobs possibly this year. And there's a website that tracks who's all getting cut, or not who's all getting cut, but what departments are getting cut the most. So while we're waiting for Jerome Powell, let me look at this real quick. Okay, so the deadline for federal agencies to submit mass layoff that was due last Thursday. So looks like the biggest cut is coming from the education department. So it looks like they're looking to cut about 50%. And wow, so the IRS is looking like they're going to cut about 12,000 employees. Interesting about the National Oceanic Atmospheric Administration, they're cutting about 1,000 employees. That's the weather, right? Yeah. So the Veteran Affairs, I am definitely more concerned about the VA, and I'm gonna be biased here with the VA cuts. I'm a veteran myself. 20 years in the Air Force, so getting an appointment at the VA is already difficult as is for us veterans. And I'm sure, let me know in the comment section down below or in the live chat if you're a veteran. They're looking to cut about 70,000 employees from just the Department of Veteran Affairs. But I'm not sure if that's going to be like cut by each department or, what area they're going to cut from. Maybe just the headquarters. I don't know. It doesn't say. There's another one that you could probably look at. I think this is a good one. I'll see if I can share this here. So many pop-ups. Maybe it's not a good website, but yeah, there's like a little tracker here. It says DOE or Department of Education, they're looking to cut by almost half of its employees. That's crazy. Let me know in the live chat if you're one of them. And then NASA, interesting. NASA's cutting 20 employees. not that many. DOD, they're looking to cut 4,000 DOD employees. So yeah, that's IRS, 7,000 employees. Department of the Interior, National Park Service lost about 1,000 employees, which may impact maintenance and visitor services across national parks. EPA, they dismissed over 300 staff members, including environmental scientists and regulatory enforcement officials. VA, more than 1,300 VA workers were terminated, and more are expected. Department of Housing and Development, around 780 employees have been cut from the HUD, and so it looks like they're looking to cut that workforce by half. So almost 4,000 positions will be let go. Department of Culture, okay, so thousands of employees were released from the USDA. Department of Energy, another one, less than 700 probationary employees have been dismissed. FAA, another 400 employees have been dismissed. Talked about the weather guys, and then Consumer Financial Protection Bureau, so CFPB, about 200. Wow, interesting. Most of them were not probationary employees. They're estimated to have been cut. Let's see, they're terminating. Okay, so the judge did direct the government to stop terminating CFPB employees. Department of the Treasury, 76 employees, and then USPS. USPS has announced that it will be working with DOGE to cut 10,000 jobs. So if you're a postal worker, looks like DOGE is going to cut 10,000 jobs, and the outgoing postmaster confirmed he had signed an agreement with DOGE and the General Services Administration, that's GSA, to identify and achieve further efficiencies. Okay. So yeah, as of right now, I guess they were looking at 250,000 jobs being cut, and that is obviously a concern for the unemployment with the Federal Reserve, because can all 250,000 jobs go to another public sector job within the federal government, or can they go to the state and local governments? I don't know. The private sector jobs are not as strong, and I've been covering that almost every month. But about the private sector job, and you can look at the labor statistics there. I think those are some of the biggest concern for them is, man, can they all do that and just kind of, can they do it all at once and doesn't hurt the labor market, right? And as a veteran, I'm concerned for all the veterans, and if you're not a veteran, you may not have the same sentiment, but something about the veteran community is we're close. I walk up to a random Army guy or Air Force guy in the VA hospital, and I can talk to him about the job they had or the job that I had, and it's an instant connection, that only veterans can understand. So hopefully it doesn't, I know I say hopefully it doesn't impact us as much, but I think it will, unfortunately. So, but anyway, let's go into Jerome Powell here and see what he has to say about today's report here.
Chris Waller dissented
always on
because
time,
he
too.
might be or might not be in the running to be Fed chair. This is going to be a very difficult messaging act for Fed Chair Jay Powell, especially given the flipping and the flopping from December to January.
Governor Waller can speak for himself. I'm sure he's got other ambitions that maybe Chairman Powell doesn't want to talk about in this news conference. Bob, you're always fantastic about this. What would you ask the chairman in this news conference? If you had a seat in that
Dysfunctional
room
family.
right now,
Love
what
it.
would be top of mind?
I'd ask him what the Fed is watching to gauge inflation expectations.
What do you think they are watching? Because it doesn't seem to be the survey data. Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
Yeah, I agree with Silent Bob. This is probably all going to go, probably not going to impact us as much if they don't mess with our appointments and health services. But, what do we all need, right? It's the health appointments for all the problem that we have. But anyway, here's
A challenging news conference. That news conference begins right now.
Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year. unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change. I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know.
We've heard that word transitory before with inflation.
For signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27. Of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so
good question.
That's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
Pandemic, yes, during the
because you
pandemic.
could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, you know, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. You know, we haven't had real price stability fully reestablished yet, and we have to keep that in mind. And you know, we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is from each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them. And we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels. You know, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer, and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that. And the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation. Which by the way has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that. And we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast. And I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. You know, it's
I
like
need somebody
plane.
to ask about unemployment
for a landing. As we get closer, and we, by the way, we still think that reserves are abundant. Although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth? And do you see the composition of job growth as something that has policy implications?
Here we go.
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
I'll do a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So But we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move. As I mentioned, I think we're well positioned to wait for further clarity and not in any hurry.
Matt.
I'll show you guys what he's talking about later on when he's done.
With CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to our uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
He's like, pass.
Hi, Jeff.
Not gonna answer that
from
one.
Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Last one.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing. And really, people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than it. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play. And as I mentioned, well supported. Thanks very much.
Okay, so that was the end of it. Okay, so just want to go over real quick what he was talking about. The sentiment for the Federal Reserve. Let me pull up this window here. Is it this one? Yep. Okay. So while we were all listening to the Fed Chairman Jerome Powell speaking. So what everybody, all the journalists in the room, what they were talking about is this. So the uncertainty and risks around their economic projections have like the risk, the uncertainty has heightened, right? So that's what he was talking about. And what people were asking is from the December projections, if you look at the dash lines here, okay, can you see my drawing? Okay, so this is from the last SEP. So that's summary of economic projections. So the uncertainty was about like even, right? Broadly similar and to higher. But now for the March projection, it is showing a lot higher than the one in December. And the risk of GDP growth also it's gotten a lot higher than the previous month. Now, oops, didn't mean to draw that. And then if you scroll down to the SEP on page 11, it's also going to show you that the unemployment, they have a lot of uncertainty on that too, and I'm not surprised. With the 4.4% is what it's showing right now. That's by the end of 2025. Obviously, that could change every time it comes out. And this SEP comes out every 3 months. So the next one, when it comes out, it'll be in June. So could it move to from 4.4? I'm sorry, it's not 4.4. It's 4.3. So could it go from 4.3 down to 4.4? What if the unemployment rate by the time it comes out in June is at 4.5? Does that mean that this is going to change to, let's say, 4.6? There could be like a market kind of panic a little bit. If it comes out that way, then the unemployment keeps going up. Then Jerome Powell, does that mean that he's going to keep saying that this data is looking somewhat healthy when it's not, right? Consumer sentiment really matters. And, he kind of downplayed the consumer sentiment, but you shouldn't. No one should, because let's say I am out and about, right? And I'm having a conversation with a group of friends at a restaurant. And I say, man, the economy is turning into poop, and I probably need to start putting more cash aside in my savings account. I'm probably not going to invest as much. That's the kind of information, say the conversation happens. This is if. And those friends of mine would probably talk to other family members, friends, and everything. They post it on social media, and everybody else is going to feel, not as confident about the current economic condition, and it spreads a lot faster. So what happens when people have that feeling, right? People will stop spending money as much. People will hold on to their cash. What happens when people hold on to their cash? Businesses don't generate enough revenue, or they don't get in as much revenue as they did the prior year. So what happens when the earnings comes out, right? Let's say people are not buying as many iPhones like they did in 2024, and in 2025 comes in 20% less than the year in 2024 because of the economy. Share prices go down. What happens to when the stock market goes down? Then people don't really sell their shares, or maybe they will sell their the stocks and get those losses. And what happens when there are losses in the stock market? The government doesn't get any revenue from the capital gains. So if you look at the 2022, there was like no capital gains revenue from almost none anyway during the bear market. So, we don't want the recession. We don't want the market to continue going down. A positive rate is always a good thing. But when you're a long-term investor, just stay focused on what you're supposed to do in the next 10, 20, 30 years. If you're a young investor, you want to treat this as a discount. In the short term, though, it could become a problem for the government when they, especially when the Trump administration has been talking about tax cuts, laying off 250,000 federal employees. And if the private sector jobs are not as strong because the consumer sentiment, they don't spend as much money, and it just kind of like a domino effect. It just kind of not a collapse, but then it does affect businesses. And businesses, the first line of expense that they're going to cut is labor, right? So when economy is weak, people are not buying enough goods and services. Businesses will cut their labor first. Why? Labor is the most expensive line item on anyone's balance sheets or anyone's cash flow statement. I have my own cash flow statement for my business, and I look at it. Labor is the most expensive line item. So what do you think is going to happen? Layoffs start to happen. when there are more layoffs and they're not hiring anymore, people who transition out of the public sector to the private sector may have a harder time looking for a new job. What if they continue to lay off people, right? So I know they talked about cutting the workforce by, I believe it's like 25% for the federal employees. And then going into 2026, what if the labor market is not as strong as it was and they can't find their jobs? Unemployment goes up from 4.6, 4.8, goes up to 5%, right? So that's what people are worried about, what investors are worried about. This is the biggest, I would say, indicator besides the GDP and everything else. That is the biggest indicator for a potential recession. Could it be short term? Sure. But it could become a problem if that consumer sentiment just continues to drop, let's say below 50. I would say that's probably going to likely be a recession. But this is what the press conference was talking about. If you guys were watching it from the beginning, you can look at this on the SCP. You can download it. It's free. Go to the FOMC website, and you can download today's version of the SCP. So what does it mean for you guys with the interest rates, right? The high yield savings account will remain high at probably 3.7, 3.8, maybe 4% for the high yield savings account. Credit cards, they're going to remain high. I think car loans are probably still going to be at about pretty high. I never recommend taking out a car loan anyway. People on the student loans, you might need to continue to pay attention to what's going on with the Trump administration. There are several tax proposals, and I'm actually working on a video right now that all the list of all the tax cuts and all the tax increases proposed by the Trump administration and Congress, the Republican Congress. And I'm going to make a video about that, and it should be coming out probably in like a week and a half because it's a lot to go through. If you want to get ahead and just kind of read about the taxes, the tax proposals, just type Ways and Means Committee and for the tax outline. It's all in there about what they want to propose. If you're tuning in, you're kind of getting the ahead of what I'm going to talk about in the future videos. They're talking about eliminating the HSA, which is the health savings account, to replace it with a universal savings account. That's all in there on that website, and I'm going to talk about that in the future video. Is that going to happen? I don't know. There's another proposal to enhance the HSA by increasing the contribution limit and potentially eliminating the requirement to have the high deductible health plan as well. But that's, the bill is not drafted yet. They just continue with the CR they just passed, right? The Democrats are pretty divided about that, and I think they're still kind of broken up about Chuck Schumer, but they passed that. They're going to continue funding the government until the end of the fiscal year, which is September 30th, 2025. But when the new bill gets drafted, that's when we know what is going to be included. They're talking about maybe getting rid of some of the retirement accounts because there's so many of them. And that's why they're talking, my channel, this personal finance channel, I'm definitely going to talk about that universal savings account. Stands for, it's USA, which is weird, but a universal savings account that's going to replace like HSA and potentially maybe like Roth IRA and make, because that's going to be a Roth account per the proposal, but more to come. You guys will get to see that. If you're channel members, obviously you're going to see those videos in advance. I have always been apolitical. I don't take sides, left, right. I am right down the middle. I have made videos about, Joe Biden's tax cuts and tax increases in the past. And people in the comment section will say, size of, he's didn't know size of MAGA or whatever. And if I criticize any of the tax proposals on the Republican side, I get called like a liberal. You can't win in the comment section. And, most of the time they never finish watching the video anyway. So always right down the middle. And I always want to look at things more objectively, especially with the new tax bills and tax laws coming out for 2026. They have to. it's going to happen in 2025, because if he doesn't get that Tax Cuts and Jobs Act 2.0 or TCJA 2.0, starting in 2026, your tax rates are going to go back up to how it was before 2018. So your marginal tax rate going from 12% to 15%, that is a significant jump, right? So just stay tuned. Next time, I do live streams every other Wednesday. I do all the videos, updates, news on my channel 3 times a week. But just, if you want to just get some free resources, check out firesideshare.com/resources. You can join my private client program. It has been phenomenal for all of my clients to be in that. And you can always start with a 60-minute consultation. But man, this was a 2-hour live stream, and I really, really appreciate all of you guys sticking all the way till the end. And this we'll see how it goes with the economy going forward. But just stay tuned. Just come back in 2 weeks, and I'm going to talk about the financial independence calculator. So I appreciate you guys being here, and until next time.